All right, all right. Good morning, good morning. I promised you last Wednesday that we'd go through the Mag 7 and we only got to one. We got to Apple. I don't think we got past Apple because we were talking about the S&P 500, we were talking about the long-term charts, we were looking at all of the accumulation distribution models, we talked about all that great stuff. So this is going to be a continuation of Wednesday's class. So if you didn't attend Wednesday's class, after this class, go back and watch the Wednesday class and then come and watch this one again. Or just go watch that one after you watch this one. That'll be okay. Doesn't matter if you got them out of order. We're going to be talking about the accumulation distribution model. As you all know, that's kind of my thing. I learned that when I was in Chicago at the Board of Trade. And that's how they do things. And it's not like it's a secret, but it's kind of a secret. It's not really a secret. If you want to learn about it, you can. It's called the Wyckoff Accumulation Distribution Model. And you can go out and books about it. Everything's about it. It's not a secret, but it's the way the big boys trade. And it's the way they trick us into giving them all our money. Because as I always say, there's three big companies in this financial world: BlackRock, Vanguard, and State Street. And they have all the money in the world. The only money they don't have is the money that's in your pocket, and they want it too. All right. They're greedy buggers. They're greedy. They want that money too. So they trade in a way that makes us give them our money. And that's why we lose and they win. And when I say we, I say I'm talking about retail traders. So what I want to do is I want to educate you guys and teach you guys how they do that. And if you can learn just that one thing from me, nothing else, you don't have to learn anything else from me. But if you just learn that one thing, it's going to save you a whole lot of heartache and turmoil. All right. Because that's just the way the system works. And if you don't believe that these markets are manipulated, then you're on the wrong channel. Because this is the market, this is the channel that teaches you how the market is manipulated. All right. And it is definitely manipulated. And you have to remember that we, as small speculators, we're just a fly on an elephant's ass. That's all we are. Now I got to go to YouTube confession because I just said a bad word. YouTube confession. You know what? I don't even ask anymore. I just, every time I'm just like, yeah, I probably did. Yeah, I probably did. Yeah, I probably did. I probably said a bad word every single time. Whether I did or not, whether I can remember whether I did or not, I just, you know what? I confess my sin on every single video. It's probably why my videos won't go anywhere because I say bad words. Of course, I've seen videos that say bad words go, viral. Have you ever had a viral video land? No, I never have. But you guys can help me go viral. Hit that thumbs up if you like our videos. That always likes, that's one of those things that the little YouTube algorithm looks at. They said, do people like what Land's saying? They do. Oh my goodness, we should show him to more people. Not that it really matters. This is a lab for the university classes that we teach down there. And that's the most important people to me is you guys. You guys that come here for the labs, for the university classes. Not that you guys who aren't part of the university aren't important to me. You certainly are. But this is a lab for my university classes that I teach at Utah Tech University. And we are in the middle of our options class. So today we're going to talk a little bit more about options, and we're going to cover the things that we covered in class on Wednesday. And what we primarily talked about on Wednesday, we talked about the theoretical value of options, the Kelley Blue Book of Options, which is the Black-Scholes model, and it's right here, theoretical value. Let me make this screen a little bit bigger. That's the best I can do for you. And I've got the screen white. You notice that I run my software white. There's actually a black mode, which is really cool. It's kind of like, spy versus spy version, but that makes it hard for you guys to see. You might like your version when on your own desktop to be the black version, which is really cool, but it makes it hard to see on YouTube. So I run the white version, and that's okay. They're both good, but I like the black version myself, the dark version with all the dark stuff. It looks really, really professional, but the white version works better on YouTube. You guys can see it better. So that's why I do that. But you got a choice. You got a choice when you got track and trade. When you got track and trade, you got a choice. So that's what we're going to be talking about. We're going to be talking a little bit more about placing options orders. And we're going to talk about this table down here and the value of that table. All right. So that's important for us. And we're going to come in, and that premium per day is not showing up. I wonder, oh, it's because it's 0 days till expiration. Let's come down here and go to a 91-day expiration. Oh, there it is. It popped right on there. Okay, so everything is showing up in here, and we're going to go through. We're going to place a couple of options orders, and we're going to use this table down here. All right, we're going to talk about what all these important tables are. And we're going to place orders, and it doesn't necessarily, now remember, today is a class. All right, it's a class. I am going to talk to you a little bit about the accumulation distribution model. And just because we place option orders today, these are not trade recommendations. I want you to be mindful of that. All right. These are not trade recommendations because we're in the throes of a class, and we're going to be placing orders to show you how to do it, not necessarily. I mean, we're going to be showing you when to do it, but we're going to do it anyway, even if it's not the right timing. And the reason is because you got to learn, right? And today is the day to learn, not necessarily the day to put them on for sure. So keep that in mind. A little disclaimer here. What we're doing today is not trade recommendations. All right. So don't go putting on an order because Land did. All right. Because that's not necessarily what we're going to be doing today. Hope that's clear. Randy, that's a good question. Randy says, hey, I want to know how you change that white background to black. Let's see if we can figure it out together. All right. You come up here and you go to view, and you come down here and you go to, I think it's something like multi-chart. Nope, it's not that one. Color theme right there. Color theme, application color theme, light, dark, traditional. Chart color theme, custom theme 1, custom theme 2, reset chart colors, custom dark default, light default. See, and I think I've got mine set to light default. Oh, I got mine just right there. I just did the first one. I don't know what these do. I didn't play with them. They're relatively new. Well, not really. They've been around for a while, but light and dark right there, and traditional. I think traditional is gray, like that traditional Microsoft color. I don't know. Anyway, mine's the light one. And if you want the dark one, click right there and it'll flip it over to the dark one. And it's kind of cool looking. All right, there you go. Now look at me answering questions. How about that? Frosty says, I don't sell fake dreams. Well, that's good. I'm glad you appreciate the fact that I'm not selling fake dreams. This is a, if anything, I kind of deter people from trading, if anything else, Michael. People watch me trade. They're like, ooh, I ain't doing that. And that's okay, because we're just here to learn. I'm not trying to blow smoke up people's ass. All right. You can lose money doing this. Trust me. Ask me how I know. All right. And then, of course, we all know with these little guys, we have to introduce you to our friends. These are the guys who actually move the markets. So when you get in, you got to have one of these so you can stab him in the neck. And that's what makes the market move up and down. That's the power we have as small speculators. All right. We sit on the elephant's ass and we poke the elephant. Here's the elephant. Come on, BlackRock. Make that market go up. That's what we do. That's our power. That's our authority. All right. So there you go. That's how much power and authority we have of moving the markets. But the markets get moved by BlackRock, Vanguard, and State Street. Now, the great big huge companies, the Magnificent Seven, as we call them, all right? And here they are: Apple, Amazon, Google, Mags, which is Facebook. Oh wait, Mags, that's all of them combined. Sorry, that's all seven in one ETF. So let's start over. Apple, Amazon, Google, Meta, which is Facebook, Microsoft, Nvidia, and Tesla. That's the seven. And I add Palantir because I love Palantir and they are a great company. And they just got added to the S&P 500 and they're in massive growth state. And they are, guess what they do? They run AI software to help the Pentagon balance their spreadsheets. How about that? So that's what they're in there trying to do. They're trying to help that company, help companies in general, but primarily they're big money makers. They got a contract with the Pentagon to help them try and pass an audit. And that's what they do. So Palantir, good company, and we like them. And so they're in an A1 X1S A1 right now. But actually, because this is the A1 drive, thing back here's the A1 drive, but we got a reset right here. And why am I jumping into this so soon? Just because it's Palantir and it's the one I love. All right, let's come back over here to Apple. Apple is down here in a 2-drive pattern. So we're going to come in here and we're going to come in and just measure. We'll just do a little, and we talked about Apple last time, so I'm not going to spend a whole lot of time on Apple. Hold on a second. I got to get my voice back. All right, so we're back. All right, and I think I'm back. Am I back? Yep, I'm back. It says I am. All right, so the ABC pattern, that's the little topping formation that we got going on here. And you can see, if you want to really get deep into this thing, hit that delete. And here's the head and shoulders formation. This is your left shoulder out here. This is your neckline. This is your head. This is your neckline. And then this is your right shoulder. And that gives us this ugly little neckline right here. And I hate descending necklines, but that's what it is. And it's a descending neckline. And it just barely broke the dead neckline right there. So what does that mean? That it broke the neckline? Well, Lan, I don't know what that means. That means that the market is supposed to break right there. And everybody's like expecting Apple to go up at this point, and that's barely getting a sell signal right there off of this top formation. The market went sideways. You can see all the way from back here, clear back in July, had this one little bump in it, and then another tiny little bump, and that was it. That's all Apple did for us. And you guys all know what I feel about Apple. I mean, if you've been here for any longer than 2 days, you know I'm not a big Apple stock fan. They claim to be a growth company, and that's why they don't give a good dividend. And that's their excuse. Oh, well, we're such a good growth company, we don't have to give dividends. Okay, Apple, whatever. Look at your growth. Not, you know what? The only reason they grow is because they buy back all their shares and force their value up. So that's Apple's not, in my opinion. They have only got they're a one-trick pony. They got these little things. Oh yeah, they got computers, but if you go look at how many people actually buy Macintoshes, it's like 18% of the world. You know, it's like almost nothing. Not that you can't build a big company off of 18% of the world. You can, and they have. But they're such a big company now, they're not a growth company anymore. And I don't know why they keep pretending that they are. Start giving dividends is what I'm saying to you, Apple. Quit being so skinny-hearted. But Lan, we do give dividends. Oh, I know. It's like toilet paper to you guys. Come on. They're little itty-bitty quarterly dividends of about a penny. It ain't worth it. Ain't worth it. All right, that's my rant and rave about Apple. But anyway, that's Apple, and everybody loves them for some reason. And they call themselves a growth company, and they are part of the Magnificent Seven. And their little one-trick pony is kind of running out of steam, if you ask me. When was the last time you bought a one-trick pony from them? You got one of these? This is like the 14, and they're like on the 84th version. And this is like back, you know what? The iPhone 4 was the best phone they ever had. iPhone 4. I love that thing. That was the most awesome. I've still got it. I tried to make it work the other day, and it actually worked, but they wouldn't let me update it past some like ancient operating system version, and then because of that, none of the apps will work. But iPhone 4, best one they ever made. Should have just stopped right there. Anyway, let's move along to Amazon. Amazon, everybody loves Amazon. Everybody loves Amazon. All right. So there's your nice little trend line. That's your natural trend line. Let's go off the very bottom, because computer systems will go off the very bottom. So there's your very bottom one right there. You can see where it got respected here again, and here again, right off that low point. But I knocked that very low point off on that last one, and we got a little bit of respect coming in some of these other places. So we got a little bit of respect here and a little bit of respect coming off of there like this. And then we didn't get any respect until all the way out here, and that's not respect. It didn't respect it. So this one actually got better respect than that one. So boom, gone. See ya. And that's where that baby broke right there. And the name of the game is to draw these trend lines, find out where they respect. You get these 3-drive patterns. It's kind of like I take this natural trend line, and this is kind of the Elliott wave pattern, right? But here on Amazon. We started off with this one. We went up. We kind of got this little, I call them mountains. These little mountains right here, right? And then we came in and we could do it again. We go from this one, and we got a little mountain right in here. Just one. Ooh, that was like a little peak. And then we got another one right in here, up here, and back down to the line, just like that. And then we got one more. Look at that. We got a fourth drive in this baby. Now, that's rare. We don't usually get 4 drives. We usually get 3. Doesn't mean you can't get 4. You certainly can. But we got 4 this time. And so that was the 4 drive pattern. Generally get 3. But that fourth one, not the greatest, but it was there. It was there nonetheless. All right. So you get your big lows down here, you draw your trend lines, and you start looking for respect. I want some respect here. Give me a little respect. And then when it breaks that respectful line and you get these little mountains in here, that's your trigger. That's your trigger. There's your sign right there. I don't know how it gets any more obvious than that. And that's how you do it. And as long as it stays above that trend line, if you got an option, you can stay in. Or if you got shares, you can stay in. And realize it's going to go up and down, and hopefully it's going to bounce off that. And you don't know that until, until you start getting some respect up here. So we might draw it a little bit tighter up in here. We might come in here and say, well, what about that one? Well, there's your first respect right there. See that? Nice little respect. Okay. So, oh, that was cool. Wrong tool, man. So there's where that one broke. And you can see that it's got that little blue line in there. See the little blue line? That little blue line is kind of like, I call it the magic blue smoke of trading. All right. So they're kind of the cheat codes. And it comes with the bulls and bears. And the bulls and bears was turning the price bars red, yellow, and green in here. And that's one of my favorite indicators. We mentioned indicators last week or on Wednesday. And we talked about the CMF. We talked about the MACD. We talked about how to read these things and why we use both of them. And the reason we use both of them, and I'll just mention real quick here, is because the chalk and money flow is the accumulation distribution model based on the large speculators. This tells them when to buy, this tells us when they're buying. All right. That's what this was designed to do. It tells us when the big, large banks, the 3 big nasties, are buying. All right. That's when they're buying. They go through the process of accumulation. They buy low, sell high. Wow. What a concept. Something we've all been heard and told and taught our whole lives, right? Buy low, sell high. Well, if that's the name of the game, why don't you do that? Why don't you do that? Because it's no fun. Nobody wants to buy a market that's doing poorly. Oh, that market sucks. It's doing poorly. I ain't buying that market. I want to buy a market that's doing well. Well, if you buy a market that's doing well, you're buying high, you're buying high, you're buying high, you're buying high and trying to sell higher. And that's a really hard trick to do. Buy high and sell higher. Not that you can't. You can buy up in here, wait for it to flush all the way back down and then come higher again. You can buy up in here, flush all the way down and wait for it to come higher again. But usually what happens is we buy high and then we feel really bad about what we did because we're losing our money for the next month. And then we bail out just as it starts to go back up again. It's called the accumulation distribution model, and it's how these guys get you to give them your money. So they buy down here, and that's what this indicator is telling us. This says, hey, the big speculators, the big banks, the big hedge funds, they're all buying right down in here. Not much to buy in there, but they're starting to buy right in here. They like to buy down in here. All right. And then the reason I like the MACD is because the MACD tells us when that gives us a little bit better timing on those. So we don't actually buy the MACDs up in here. A lot of people are like, oh, MACD, let's get in up there. No, you want to get in down here with the MACD. All right. When it goes red, 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 wait. That's like, wait. See this right here. When the MACD starts to do that and it's matching this green one here, this tells you all the big speculators are buying. And then this tells you when they're getting ready to turn the corner. Turn the corner, red to green. A lot of people will buy here. Oh, you go short here, green to red, right? Green to red. That's where you take your profits. Or you go short. You go short if you want to. But if the market's on the way up, you don't want to go short. Those are counter trends. It's really hard to get money on counter trends. Counter trends on the way down, on the way up market. Well, market's moving away. It's 2 steps forward, 1 step back. 2 steps forward, 1 step back. If you're trying to make money on the 1 step back, that's tough. All right, because the markets don't generally move back far enough on the counter trend to make any money. Not that they can't. They can. I mean, you can, if you want to play that game. It's just the smaller trend. The bigger trend is the uptrend, a downtrend, uptrend, downtrend, uptrend, a downtrend, uptrend. And notice that oftentimes the downtrend is choppy, chop, 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 chop. That's because these guys are buying up the downtrend. All right. They like to buy low and then anticipate the rally and make money on the way back up again. That's how they do it. And so we need to do the same thing rather than buy all the way up the uptrend. And that's what we do. We as small speculators, we like to buy all the way up the uptrend. Why? Because that's how they've trained us to do it. They want us to do that because that's how they take all our money, because they're selling to us. Look at this, all the way up the uptrend, all the way up the uptrend. They are selling. All right. They are selling. They're selling all the way up the uptrend. So remember, for every buyer, there's got to be a seller. And if you're buying all the way up the uptrend, who's selling to you? Well, it's the big speculators, the big banks, hedge funds who bought down here in the low regions. They bought low and then they sell to you all the way up the uptrend. Well, you're buying all the way up the uptrend. You're going, oh, this is a great market. It's going up. I think I'll buy it. Oh, look, oh, it's still going up. I'll buy some more. Oh, it's still going up. I'll buy some more. That's what they want you to do. Why? Because they're selling to you. They're selling all their positions to you as you buy going up that uptrend. But Lan, I thought I was supposed to buy a market going up the uptrend. Who said that? Who told you to do that? Not me. I've never told you to buy going up an uptrend. I've always told you buy low, sell high. That's my theory. I don't like that buy high, sell higher. So quit buying all the way up that big green trend. Stop doing that. Buy when it's coming down. Buy down in here. Buy when they're buying. And then the turning point, now because we're small and we don't have deep pockets, we can't sit there and buy all the way down a big downtrend like they do. All right. They dollar cost average and they build those pyramids and they pull all their money down into the bottom of the pyramid. And once their pyramid is very strong and stable with a big bottom layer, then they can turn and start to bring it back up again and sell out to us as we like to buy into the big uptrends. Don't buy into uptrends. What are you doing that for? It's just going to get your hiney handed to you. All right. So that's the turning points right here. And we're getting some turning points down in here. It's a little skittish. It's a little skittish right in here. You can see with lots of going from red to green, red to green, red to green. That's an accumulation stage. So that means that this is down here. These boys are starting to accumulate some shares in there. Now, does it mean that they can't drive it one more time down? No, in fact, they oftentimes do. Because this here is the very peak, and this is just the first drive down. And as I said, we're working off of a long-term chart right now. If you come over to the monthly chart, we've still got some downside potential. This is the S&P 500, and that's that Fibonacci bow tie right there. And that market generally comes back to those bow ties. Doesn't have to, but my bet is we're going to see prices right here. I am calling and have called for that market to go to 481. That's 483. 483. I think we're going to see prices down there. Doesn't mean it can't just come down here, touch that little blue light, and turn and rally once again. It can do that. It's done that before. Does that a lot. Likes to come down. But look at all these places where it comes down and breaks that blue light. Breaks it and handily goes past it. All right. That's Corona. That's Corona. That's how bad it was during the coronavirus. And then we had this thing and nobody even said anything. Like, oh, Corona, worst drawdown in the world. Oh my gosh, the whole world, shut the whole economy of the whole world down. And that's what happened to the stock market. And then we had this under Biden. And nobody said a word. You didn't even hear about it on the news. Did you? You didn't even know that happened. Nobody even said anything. But this was, under Trump. So we got to, the world's falling apart. Close down the whole economy. Shut everything down. The world's coming to an end. And Jesus will be here tomorrow, right? And then this happened, which is like twice as big, and nobody said a thing. Nobody said Jesus was going to come tomorrow on that one. That's just normal movement of the market. That was all right. Okay. So we're going to have another, don't drag that. Are we going to have another coronavirus version of this thing? Probably. That's what I think. I'm not real bullish on markets. Does it mean you can't have some short bumps and rallies on the way down to there? Yeah, probably can. And we're seeing that. I mean, these things are screaming at us to buy them. I mean, they're just screaming, buy, buy, buy. But you're buying into a down market. We need to see him turn around. All right. We need to actually see him make some reversal patterns, is what we call that. Right. We need to see some reversal patterns. These, if it just bounces and goes back up, that's not a reversal pattern. Now it could do, we could see it do a V recovery. What's a V recovery? They're rare, but they happen. And a V recovery just means it just starts going right straight back up, and away it goes. And we might get a little bump up in here, and then it'll just keep on going. And that happened under Trump last time. After, you remember, when Trump got elected in 2016, the market was really high. He got elected. They flushed it right down. I mean, you want to talk about a manipulated market? I really keep talking about it. I need to go back and get the chart and show you. They flushed it right back down to the day, to the price that he got elected. I mean, it was up there. And then when he got elected, bam, they dropped it right back down to the date. I mean, it was just like on the money. And they stopped it, and they turned it right around there, and they started to rise again. That was a message. That's Wall Street sending Trump a message. We're in charge, buddy. We can make this thing do anything we want. That was a message from Wall Street. Now, are they doing it again? The reason I'm going to say it's not really a message, although it could be, they certainly don't like what Elon's doing, because all that money that was coming out of the government, all that corruption goes right to Wall Street, right? So it goes to the Democrat Party and Wall Street. And a bunch of Republicans too. Don't think that they're not guilty. They are. The whole thing's a big boondoggle mess. And not all of them. I know they're not all evil. Not all evil. Well, it's hard to find a good one, but they're not all evil. All right. So the money is being wasted, trillions of dollars. And that's what caused that. And we all know that. I'm not teaching you guys anything you don't know. These big runs in here, big bubbles, primarily from the government spending $7 trillion. All right. And that's how this market got up there. And now Trump comes in and stops spending $7 trillion. He says, we're not going to do that. In fact, we're going to cut $2 trillion. What do you think the market's going to do? You think it's going to wiggle around up there and keep going higher without $7 trillion of being credit card money being spent from the government? No, of course not. It's going to have a retracement. It's going to come back down. Is it Trump's fault? Yeah, you could blame him because he's not spending $7 trillion on the credit card a year. All right. So yeah, it's probably his fault. The market's coming down to some degree. But the thing is this is a perfect mathematical model. I mean, it fits right within the mathematical model, just like a train on rails. So it's what the system would have done anyway. We can just blame it on whatever we want to blame it on. It's how the big banks and hedge funds are manipulating the market. So I get a little frustrated when everybody blames it on this or blames it on that. I'm like, no, it's not that at all. It's a mathematical model, mathematically modeled formula that's built into the system through automated computerized trading. And you can see it right on the screen. You can just look at it. I mean, it's all based on Fibonacci, Elliott wave, reaccumulation, accumulation, and distribution. And if you understand those concepts, you wouldn't sit there and look at this chart and say, oh, it's all Trump's fault. You wouldn't say that at all, because it's a perfect mathematical model. And you can look, well, I'll show you. If we take that right there and measure from this point to this point, watch this. This is the math that's been used to make this happen. All right. That math model, and then you bring that up to here to the C point right there. It's exactly, look at that, within 3%. It's a 200% projection. You can't make it. I mean, you can't draw it any more perfect. It's the mathematical model out of the manual, as if you drew it by hand. It's that close to perfect. It's that close to perfect. And look at where the A is right there. And look at where 100% is right there at the back to the A point. That, my friends, is a perfect. I mean, it's not even off. It's off by 3.3% on a monthly chart. It's off by 3.3%. That's probably the retail traders, because that's about how much control we have over these markets. Probably that 3.3%. We're that fly on the elephant's ass, and there's the elephant right there. And we are the 3.3% fly on his ass. That is, I can't emphasize how that is the most perfect. It's off by 3.3% out of 200%. That's all I'm saying. That's all I'm saying. Is it going to come back to 100%? I don't know. It just has the tendency to do that a lot because it's programmed in with computers. All right. Are computers good traders? Heck yeah, they are. Look at how big BlackRock is. BlackRock's famous for their trading algorithm. And you think that the other two giants don't have trading algorithms that do exactly the same thing? No, of course they do. They're all lockstep in sync with each other, which is why the markets do what they do. All right. You can look, oh, man, that's just a lucky guess. Look at this one. This is off of Corona based off of Joe Biden's pop back on the market there. Look at that. It's classic. Look at this. From this A point here to this B point here to this high point here down to 100%. Look right there. Where's 100%? Right there. Right there where it turned. Right there. I cannot emphasize to you guys enough. It can't get any more perfect. Perfect. These markets are driven by mathematical models and systems from the people who own all the money in the world, and they can make them do whatever they want. All right. Now, do they want it to come all the way back down to here? Probably. Why? Because that's where they're going to buy and get a whole bunch of shares, and then they're going to turn the market and send it back up, and then we're going to start to buy, and they're going to sell out all of their shares to us and make a ton of money. All right. Make a ton of money. Now, this is the long-term chart, and this is the S&P looking at it on a monthly basis. Is it going to come down there? I don't know. I don't know if it'll go. I don't know if it'll do it. All I'm doing is reverse engineering their mathematical model for you that I was taught in Chicago when I sat on the back row of the seminars, and I listened to these guys teach that method, all right, to their little plebeian starting new guys that are going to be running the world. And of course, those are the guys who are running the world today, because the guys who are teaching it, they're all old and dead by now. And now you have all these new guys that were being taught when I was there running the world. And they were taught that because I was there when they were being taught that. And I'm telling you what they were taught. And that's what they were taught. So we create tools for us retail traders to reverse engineer what those mathematical models that they were taught are doing, and then we can play along with them. It's not that hard. It's buy low, sell high, guys. It's buy low, sell high. We just need to do it. Stop buying up a big green trend. Start buying down here when it's blood in the street. All right. So is it going to go right here? Usually they like to run it 2 times. Watch this. It'll come down. Oftentimes, now again, we can get a reversal and it can go up like that. Definitely can. They use the fundamentals of the market to set up their formulas. So they use what's going on fundamentally in the markets to drive their technical trends. All right. So that's what they do. They use them both in combination, one with the other. You hear me say it all the time. Some people are just like all about the technicals. Most of us as small speculators, we're all just about the technicals, right? We just want to watch the technicals because the fundamentals are too hard for us to keep in mind. It's too hard to know all the things the government's doing, all the things that every company's doing, all the things that's going on that's driving the long-term trends around the world, because these are global markets, right? I mean, Amazon, well, it's primarily a domestic company, but they sell and they do a lot of international stuff too, right? I mean, all their stuff comes from China. I mean, face it. And then so it's a global organization, but Apple sells their stuff all over the world, right? You think Apple only sells to the United States? No, Germans and French people are running around with their iPhones too, right? They all have their little iPhones. And so they're global corporations. And so for us to the fundamentals of what's going on all over the world, you know, in fact, that's something that they're talking about with Tesla, because Tesla's getting beat up really bad right now. But, you know, it's actually not getting beat up any more than any of the other stocks. They're all getting beat up like this. Even Palantir, great company. Look how far that thing's fallen. It's a government. It's the S&P 500, and they're taking it down. That's just the nature of the beast. It hit that perfect time to drop the market, and they just use it as their catalyst to make it do what they want. That's the way the game tumbles. All right, so here's the Amazon. And Amazon, what is it doing? Well, we count these waves. We got 4 waves up, and usually we get 2 waves down. All right, now this is one big wave. So are we going to get a second wave down? I don't know. Could we get a V recovery? Possibly. But if we look at the monthly chart of the S&P, we got lots more downside potential to go, right? We could have one of these events. This one here is just the little one. This is just the Corona event. All right. What if we got a Joe Biden event? Let's put Corona back and bring Joe Biden event up in here. What if we got a Joe Biden event? We'd be clear down in here, 130.9, which is the golden ratio to the downside. Could we go there? Absolutely. All right. There's a peak right there. That could bring you right into that region right there. They like to use previous levels of support and resistance as support. So support becomes resistance is what we call that. All right. So that's a Joe Biden drop right there. And it could bring us clear down here into the 130.9 range. Is that unheard of? Is that unfathomable? No, it's not at all. I mean, the media and everybody will freak out. But look at the indicators. That would bring your MACD, which is way the heck up there. It'd bring it back down into a dip. Kind of like what we got last time, dip right here, right? Doesn't mean it has to. It's just everything's lined up to do that. Mathematical models, just there. They're just there. Of course, the market can do whatever it wants. It doesn't have to follow these mathematical models. It just generally does. All right. So if we come back and look again back here at Amazon, this is generally the first drive. So we call this. We have numbers for it, X1, X1S/A1. All right. X1S/A1. And if you want to think, man alive, I'm losing my voice. I apologize. Hold on one more minute. I always have to have my tea. It's springtime here in St. George. There's little white flowers on all the trees, and we're just all going, All right. So that's an X1S/A1. Where do you learn about X1S/A1, Lan? Well, it's right here in my book. Go search Lan H. Turner on Amazon, and you too can learn about what X1S/A1s are. You can learn about all these mathematical models and how they're used. We don't have to do the math because the computer does the math. All we have to do is learn how to put them on the screen. So get Lan H. Turner's book from Amazon, and you'll have all these probabilities too. All right. This dumb thing. I don't know how to get it back. All right. And then we go X1S/A1. So that is a low probability. I like to think of that as about a 25% chance that the market's going to turn and rally again after that. All right. Doesn't mean it can't. Certainly can. It's just the probabilities are very low. Now, we got other things that we have to take into consideration. The fact that we've got this Donchian channel on here with 2 yellow lines. This is just my lazy Fibonacci ruler. All right. It's the lazy man's Fibonacci ruler. And I've got that set to be, if you go to the preferences of the Donchian channel, you can see it's set to a period of 100. All right. So my upper line is yellow. My lower line is yellow. My center mean line is red. And I have it offset. I don't know why I have it offset. I guess that's just the way it is. All right. So that's my period is 100. It doesn't come out of the box like that. And I do that just because I call it the lazy man's Fibonacci ruler. All right. So it's telling us where the Fibonacci sweet spot is. And that's right here. And the markets generally come back to those zones. So that's the delta cone of probability. Market likes to come back to the 1 standard deviation. Now that's off of this most recent move, which is all the way back to here, you can see. Okay, but this yellow line's way down to here. So we've got the Fibonacci numbers that are in here. And that's where all this stuff comes from. It's all Fibonacci. But you can see if we bring this back down to this yellow line, the very bottom of where we started that new drive. So that's what we do is we bring it all the way to the bottom. That's the poor man's not the poor man's. The poor man's, the poor man's Fibonacci ruler. It's like the poor man's covered call. So then we come in here, and this is right dead center of that Fibonacci sweet spot. See that? So again, it's right perfect with the mathematical models. It's not doing anything outside of what. Okay, here's the weirdness. This was the weirdness. That was outside the model. So sometimes it does go outside the model. Not very often, but it does. And you hear me say it all the time. 3 drives is the model. All right. 2 drives down is the model. Doesn't mean it can't go 4, 5, 6, 7, 8, 9, 10 drives. Certainly can. Can do whatever it wants. It can stop at 2 and flush. Certainly can. It's just that the model is built at 3. And most of the time, they run that model 3 times. All right. Drive 1, retracement, accumulation. Drive 2, take all their money. Pull back, accumulation. Drive 3, take all their money. Drive 3, and that's it. We're done. We're going to get rid of everything we've got. That's the last little oomph of the market, and then they flush it and drop it. Then they bring it down. They start it all over again. All right. So that's the pattern that they use. And then we are at the X1SA1, meaning it's only on the first drive down. Now, what is the first drive down? This is the first drive where they try to take everybody's money that build an upside down pyramid. So we bought all the way to the top. They sold all the way to the top. And the reason it goes up and down like that is because they're doing the accumulation distribution. They got to get you back in again. So they got to get you back in. They drop it down. They let it go back up again. They drive it back up. We buy. And then they take all of our money and they buy, take all our money. And then by the time they get up about 3 drives, their money's gone. They've exhausted everything that they bought into, and they've taken all of our money. So now they have to reset the system so they can do it again. And they bring it down. And then there's a lot of guys who don't sell. All right. So they don't sell. They drive down through here and people hold on. They know they're losing money, but they think the market's going to come back. So they hold on. And so they wait and hold on. And then they pop it like right here, X1SA1, just to get everybody to buy in again. Oh, this is great. Let's all buy in again. So then we all buy in again, and then they flush it one more time. All right. Then they flush it one more time. And that's why we come in here and we get this little ABC pattern off the top, and it'll drive up and break these blue lights, which it just did. How far they drive it? Well, they drive it as far as they need to. How far do they need to? Well, until they got a whole bunch of buyers in there, and then they flush it one more time. And they bring it down a second time. Now, is it going to happen this time? I don't know. It could be outside the realm of the 3 drive pattern. It could be outside the realm of the normal mathematical model. We could get that V recovery. I don't know. But this is generally what happens. And so that's why we play the general terms, right? And so they'll run it up a little bit, and then they flush it one more time to get everybody who didn't sell here to sell down here. Because they're like, well, these guys they're stubborn. They're not going to sell their shares. We want their shares. Remember, they want all the money in the world. So they drive it up. Then everybody starts putting money back in, and then they flush it one more time. And by the time it gets down here, just about everybody who held on can't hold on any longer, and they start to jump ship and they get out. And the ones who just refuse to get out are going to stay in for 20 years. Well, good for you. You're not part of the game. All right. So you're not trading, you're investing for the long haul. And this might take 3-4 months. You can see that's 1 month, 2 months, 3 months. They'll go through a month here, 6 or 8 weeks here, and then they'll drop it again 1 month, 2 months. We don't know how far they're going to drop it. We don't know. But they're going to probably drop it below this point. They'll probably run it up a little bit, and then they'll usually drop it below that point right there. All right. And what they're trying to do is they're trying to get everybody to sell out who's willing to sell out and to sell their shares. And as they go through another accumulation stage, and they're dollar cost averaging down, they're bringing their shares down. They're building themselves an upside right pyramid. All right. These guys are building themselves a nice, big, beautiful upside right pyramid. So their pyramid is like this. So they have lots and lots of shares, dollar cost averaged all the way down into this region here. And then when the market starts to go, they start to sell them. All right. They run it one more time out in here, and they start to sell out all those shares all the way up that new uptrend. And we start to buy in. And so we come in and we buy all the shares in here, and we end up with a big old upside down pyramid like this. And then all of our value is up here. And that's why they drop it. And they drop it, and all of our value is dead right there. They get it all down there. And that's how this whole process works. Now, that's just a summary. Now the class is almost over. That's just a summary of what we talked about on Wednesday. All right, let's go and look at Google. So where's Google? Google is down here also at X1SA1. X1S slash A1. It's the first drive down. Now, it's a big, long drive. I have to admit, it's a big drive. And oftentimes they'll have little ABC drives in here that are not quite that big to get down to that point. So where this is things flushed, you can see some little ones in there. We got kind of a little shelf here and a little shelf here. So it's a little 3-drive pattern, drive 1, drive 2, drive 3. I think we're approaching the bottom. They're going to run it. It's going to break those blue lights, but I'm not sure if they're going to do this and let it go back up and start getting a drive up, or if they're going to run it and flush it one more time. Again, if we look at the monthly pattern, it looks like they're going to flush it one more time, but you never know. You don't know until it happens. All you can do is play the odds. An X1SA1 is a low odds. But the thing is that X1SA1 is coming in down here at the very bottom of this poor man's Fibonacci ruler, which is a good place to buy. That's a good place to buy. That's just screaming, buy me, buy me, buy me. All right. That's a big screamer. Buy me, buy me, buy me. Look at this. We're getting all this right here. It's all buy me, buy me, buy me. But I don't know. It's the first drive down, and those X1SA1. It's a long X1SA1. This is unique. All right. It's a little bit outside the normal. So we're not exactly sure what's going to happen. There we go. Randy Owens giving me the thumbs up. Thank you very much, Randy. Randy says he's got my book. He's got Pit News Magazine. He's got Track and Trade for the commodities. He's got no complaints on any of them. Well, that's good to hear. Thank you very much. That's good. All right. So that's the name of the game here, folks. And so let's come in here and say that we want to buy a call option. All right. That's what we're here for. So let's buy a call option. We're going to buy a call option on Alphabet, Google. We're going to come up here to the options tab, and we're going to come out here, and we're going to have to figure out how long we want this option for. And so the way you do that is you do a little bit of mathematical projection, right? So we're going to come in here and we're going to project how far, if this thing turns around right here at this point. Now, remember, these are not, this is not a buy recommendation. Not that you can't buy here, you can. It's just a low probability that this thing's going to go to the moon. It doesn't mean it can't be a V recovery. It certainly can. And in 2 months, we might be saying, holy cow, look at that V recovery. And we're all happy that we have a bunch of shares, right? So it might do that. But the probabilities of that doing that's very low. It usually rallies a little bit, come back up, maybe test that little red line right in there, and then it will flush one more time. And that's usually what happens. And so the mathematical models are telling us this is an X1SA1, X1S slash A1. And if you want to think about it this way, you can say, well, that's got about a 32 point, is it 32 or 38? I have to draw my real Fibonacci ruler because I can't remember. My brain doesn't work that well. Okay, it's 38.2. So 38.2, you could say this X1S has basically a 38.2 chance of being profitable. And that's because 38.2 is on the top side of the Fibonacci ruler. But you can say if it's, I don't know if that's really a good representation. But this is I like to say this is about a 25% chance. So we're going to say 38.2% chance that this market could rise. All right. When we get down here to the X2S A1, all right, A1 being the first drive up. So we're waiting for that first drive up. That's why this is an A1. Oh, get rid of that. Didn't mean to do that. Delete. Not all notes, just this one. So this is an A1. It's an X1S A1 because it would be the first drive up if it actually stays higher and makes higher highs and higher lows. And then this is the A1 down here, but it's the X2S A1. So this is the first break to the downside. And then we get one more break to the downside. I figure this to be, we're going to put in here a 50% chance that the market's going to rise on this one. All right. Because it could go down to a third drive. And it's probably a little bit higher than 50% because when we're in Chicago and we're listening to them, they generally like to drive it down 2, not 3. Doesn't mean it can't go down 3. It certainly can. In a bearish market, it could go down 3 drives. But if it's in a bullish market, it generally only goes down 2 drives. So this would say, I would say this is roughly a 50% chance that this is going to go to the third, start to go up right here. So that if you want to put percentages on here, which isn't really fair, but we'll do it anyway, right? So that's a 25% chance that the market could turn and start to rally here. This is a 50% chance. And if it comes down and goes one more, this is kind of a little extended. Let's go like this. And if it comes down and makes one more and goes down here and makes an X3SA1 right here, X3S/A1, which would be your first drive to the upside. So you got 3 drives. This would be your X3SA1. We're going to say this thing has roughly a 75% chance of going up. All right. You never get to 100 because, eventually the market will go up. It always has, but it doesn't mean it has to. It could go to 0, right? I mean, we'd all be speaking Russian at that point probably, but nonetheless, it can go to 0. So that's your drive patterns for the downside on a bearish market. And that would be pretty nasty if the market went all the way down there and did that full big drive. It might not, go that far. It might be a little bit. We don't know where these things are going to come out at. But this is a downtrend, lower highs and lower lows, uptrends, higher highs and higher lows. Where's it going to turn around and start making higher highs and higher lows and start going back up again? These are called Darvas boxes. All right. So Darvas box. This would be one Darvas box. So if you want to go out and study Darvas boxes, that's a thing. Go look at it on the internet. All right. Search Darvas box and you can learn about Darvas boxes. Or you can just know that one Elliott wave pattern or one 3-drive pattern is a Darvas box. And we are definitely looking for the Darvas box to be up here. We want this Darvas box to go up. We want bullish markets. We don't like bearish markets. But it looks like we're going to get a bearish market. And if that's the case, we could get a 3-drive pattern down. And then we could get another 3-drive pattern down. And we would be in a bearish market, right? And we'd be in a recession. So if that's the case, stop that. I don't want you to auto scale. If I auto scaling, let me auto scale myself. Okay, so that would be our next 3-drive pattern. We get a little retracement back up to the 50% level up in here, and then it would flush and start coming down again with another Darvas box, and we get another Darvas box to the downside. So that's how you'd be in a downtrend. You get multiple Darvas boxes in a row, and on the long-term chart, we'd get 3 Darvas boxes down, which would be our X1, X2, X3 on the longer term basis. And that's how it works. That's the mathematical models of these things. So you get the 3-drive pattern, gives you 1 Darvas box. But if you go out to a monthly chart, well, you'd have the same thing. You'd have 3 Darvas boxes of 3-drive patterns, but that would put you into a bearish market or into a recession, right? And that's what we could be looking at. But it depends. Depends on, Donald Trump. He's shaking things up. But this is where, this is what the market's looking at. If we go into a recession, we have these 3-drive patterns. We try to recover. We get another 3-drive pattern, and we could actually get a 3rd one down here. Less likely to get a 3rd one, more likely to just get 2, and then we would recover off of that one, right? But it depends. We got national debt of 37 trillion, but these companies are all international corporations. Tesla's getting beat up. I was making that comment about Tesla, but they're doing sales just fine overseas. Their sales haven't dropped overseas. Nobody cares overseas. If you got a bunch of radical Democrats out there burning up cars here in the United States, they see it on the news and they're like, oh, well, what's that all about? They don't care. They're still buying Teslas over in China. All right. So national companies, are they going to drive the stock higher? I don't know, because the United States is the big bully on the pulpit, right? So there we go with Alphabet. I was going to buy an option just in case. Let's come in and show you how to buy an option. Let's say we think this market's going to turn right here. It's going to break those blue lights. We're down here in the buy zone. We're down here in the green zone. And we think this market's going to make a V recover and we want to get in. Okay, we come in here and we have to decide how long we want that option to last. That's where I got to and got distracted. So let's come in here. We're going to go off of this one here to this peak here. And we're going to go down to this peak here. All right. So that's how we give ourselves a Fibonacci projection of price and time, where we think that market's going to go based on what it's done in the past, based on what it did here, and where we think it's going to rally to in the future. So if you think it's going to go up, then we're going to come in here and we're going to say, well, 61.8, 78, 100% is out in here. That's out in May. 130.9 is our golden ratio. That's like if it just fell this thing right here. Let's say it does a little ABC pattern. Let's do another one. We'll just make a little projection. It's going to come up to 50%, pull back, and then it's going to rally once again. That puts us out 130, 161. That's going to put us July 1st. So we're going to need at least 3 months to get us out into this region here. All right, so we're going to go out here and we're going to say I need at least 3 months. That's 90 days. Let's give ourselves a little breathing room. We'll go out to 119. So that's how we pick how far we're going to need the market to, how long, how much time. We don't want to buy too much time, but we want to buy at least, generally I like 30 days more than what we need. And then you can give yourself a little berth in there, so buy yourself 130, in this case, 119, 147 days. Let's do 119 because we'll probably take it off before it flushes one more time. We'll try and take it off at maybe 25, 30% profit. All right, so we come in here with 119 days. We're going to look at the out of the money calls. We're just going to look at calls. We don't need anything else. So this is the call table. The premium right now is $1,382 to buy one at the money. We could buy a little further out of the money, but that would be $695. We could do that. That's at 175 call. Or we could buy it in the money. That would be $2,380. That'd give us a little a higher delta, so we'd make money more quickly, right? If we want 75%, we could buy it in the money, and we'd make our 20% or 25% profit more quickly because we got a delta of 75. Now remember, my little trick. I taught you this in class. Wednesday. So if the delta is 75, that means the market, the option, will make about as much money as if it had 75 shares of the underlying stock. So it will make or lose 75 cents or 75 shares. All right, 75 cents for every 100 or 75 shares. It's like trading 75 shares. So if you bought this one up here, it'd cost you less money, $700, but it would be trading as if it was 41 shares. And you're not going to make your money as fast, but it doesn't cost you as much, $700. So 21%, say you want 20%, 25%. 25% of $700 is the same as 25% of $2,300, but the dollar amount of $700, 25%, is less than the dollar amount of $2,300. All right. So percentage is the same. The dollar amount is less, but you're still going to make the same percentage. But it's going to be easier for it to, if a market moves in your favor, it's going to be easier for it to hit that 25% if your delta is 75 because it's trading as if it has 75 shares, whereas up here it's only trading as if it has 41 shares. A little bit of a moving target there, all right? And I showed you that chart thanks to Chad. Chad wanted to see that chart. I thought that was a good idea, so I showed you that chart that shows you the value of an option over time. And it's kind of like a amortization chart of a house, right? It's kind of hard to track, but that's kind of the game you're playing, and that's why those numbers move the way they do. Now we come and look at the theoretical value. Now remember, we talked about the Kelley Blue Book of options. It's like a used car book. The Kelley Blue Book tells you the value of a used car. Well, the theoretical value, the Black-Scholes model, which is what this is, tells you the theoretical value of the option. So if we're going to be dealing with a 119-day option, we need to look at, we got a little calculator in here, options calculator, interest rate. Interest rate is one of the things that we need to look at, and this changes. So we got to go look at it. Okay, I'm set to 4.35. So if we're going to go out 3-4 months, interest rates are, they go 3.20. Interest rates out 4 months, 4.33, 4.29. So you see that little table right there. So interest rates are about, let's put in there 4.29 for 4 months. Okay, 4.29. I guess we're going to go 3 months. Let's go 4.33. So we're going to go back to our charting software. What did I say? 4.33. And we're going to put in there 4.33. Oh, it's not going to change anything. 4.33. It's right there. Okay, so that's our interest rate. Now we're going to get a good theoretical value on this thing. Oh, it changed a little bit. You saw it change. All right. So the theoretical value is $1,235 and the premium is $1,125. What does that tell you? Well, it's a little bit more expensive. Not a lot, but a little bit more expensive than what it's trading at, which means that they believe that the market's not going up. Okay, this option is worth $1,400, but you can buy it for $1,300. It's like going onto a car lot and looking at the Kelley Blue Book, and it says that the car is worth $10,000, but you can buy it for $9,800. A couple $100 cheaper. It's not $1,000 cheaper. It's not like it's broken. It's just, they're giving you a couple dollars off. Maybe it has a crack in the windshield or something. I don't know. But there's a little crack in the windshield right here. Okay, that's what that's telling you, is that you're getting it for a good price. But the reason you're getting it for a good price is because not a whole lot of people are buying it, pushing the implied volatility up. So, you can buy it at a bargain right now. And maybe that's a good thing. You buy your little option right here at a bargain, and it breaks those blue lights. We're on the accumulation stage of the chalk and money flow, and the moving averages, convergence, divergence has gone green. Everything's saying, buy me, buy me, buy me. We just don't know if it's going to go up very high. It might go up and fluff and come back down and make that second drive. So you got to take that into consideration. All right. The premium per unit. We'll skip that one. That's just how much it costs per unit. So you're paying $11 on an $1,100 and it's multiplied by 100. All right. That's what that means. And then premium per day. That's how much you're losing in value on a straight scale. You got to make about $9 a day on average to outperform time decay. Now remember, you have two different types of value in an option. You have intrinsic value and you have extrinsic value. The intrinsic value is the value from where you bought it to where the market's trading. That would be intrinsic value. So if you bought it at $2,000 and the market's trading up here, you'd have $1,000 of intrinsic value, but you'd be giving them that's your own money intrinsic value. You haven't actually earned it. So you buy it at the money, and then if you the market moves in your favor, anything from where you bought it to where it sells, that's the intrinsic value. Extrinsic value is the time. So we bought 119. We're looking at buying $119, 119 days worth of time, and that's the extrinsic value. All right. So that's the value of the option, which I like to call that as opportunity value. Okay. So you're paying for the opportunity to make money. And so you have to pay, in this case, at the money, $1,135. Now you could pay it out here, $705, but then the market would have to move at expiration, would have to be above 705 as opposed a 175 call. It'd have to be above 175 as opposed to 165. So that'd be 10 cents higher at expiration. Remember, at expiration to break even. So we go with this one down here. We pay a little bit more, so we don't have that little buffer. But if you're not worried about it going to expiration because you're just going to take it off at 25%, you could do this one and just take it off at 25%. Either way, it doesn't matter, right? As long as you're just going for that 25% bump, or 50, 60, 70, 80, 90. Depends on how bullish you are on the market. So we're going to come in here and go across one more time. Theta, that's a little column that we use. Theta means how much the time is going to decay, and it says minus 22. It's just a number that gets added in. We use that number actually to help you create the theoretical value. So this number here is built into this number here. All right. And then the volume. Now the volume in open interest is how many people are buying these things. Well, right here, there was 73 of them bought it today, and there's 877 of them bought it still holding on to it from when they bought it earlier. All right. And right here, volume was 22 bought it today, but 3,000 have bought this one over, the last however long. They're still holding on to it. So that's how you think about this. Volume is today. Open interest is the total number of options being held today. All right. Volume and open interest. Now we got a little rule of thumb, and the little rule of thumb is we would like that to be 100. And this one to be 1,000. Now this is 3,000 and only 22. So not a lot of people are buying it today. So that's going to make your spread be a little bit larger. So you can see the spread is $20 for this one and $10 for this one. So if you buy this one, you only have to pay $10 in spread. If you buy that one, you're going to have to pay $20 in spread. Now that's a cost of doing business. You have to pay the spread, the difference between the buy and the ask, or the bid and the ask, right? Or the buy and sell line here on Track and Trade. We call it the buy and sell line. So you don't have to worry about the bid and the ask. Am I buying or am I selling? Or am I selling or am I buying? I'm not sure. The bid and the ask. We have that confused, but so we just call it buy and sell line. All right. So we come in here, and that 22 is not quite at 100. This one here, 73 is, and that's going to make it more liquid. Just makes it so you can get in and out easier. Now, closer you get to expiration, the more liquid this will get. More people will start trading it. More people trade the shorter term options. So you come down here and look at maybe 56. So you got bigger numbers in here. Come down to, I don't know. These are all weeklies. I don't know. Let's see what the weeklies are. Yeah, more people are trading the weeklies. I'm not a big fan of that. I want to be down here. I want to have some time, because time decay starts to decay very fast towards the end of the time, and doesn't decay very fast at the beginning. It's not a linear line. You go like this, and then the last 30 days, man, it drops so fast that the value is almost difficult for the market to outperform. So the market has to move in your favor far enough to outperform time decay. And time decay on the option, as it decays over time, we talked about this in class, the beginning of the time decay is a lot less than the end. And so if you have more time, the market doesn't have to move as far to outperform the loss of the decay of time on the option. All right. That's called theta. And so that's why we like to have a little bit extra time as well, so that we don't have such that big drop off. So you want to be out of the market. You don't want to be holding on to options that are only 30 days long, unless you're day trading them, right? If you're doing really short term day trading stuff, you can get those. But for the most part, these little weekly options that only have 7 to 14 days, those are for day traders. You start getting up into the 30 days, that's not good. 56 days, that still is, well, what do I think Mark's going to do in the next 2 weeks? Okay. You get out into the 119, 150 days. Now you're starting to talk about, okay, how far is it going to get in the next month or two? So that's where we're at right now. So we're looking to see you in the next month or two. So we're going to come in here, and that's your spread cost. All right. You want that to be as low as possible. And then we're going to come in here. That's the spread percentage. It's going to tell you how much you're going to be spending, percentage of the overall premium. And then this is your days range. And then this is your probabilities. We talked about probabilities. So you got a 60% chance, and anything right at the money is going to be right around 50, 60% chance. Okay. 50%, 60. So you got probability being out of the money is 39%, and probability being in the money is 60%. So that's saying you got a 60% chance that this thing's going to make money or be in the money when it expires. And then down here, you got a delta of 60. So that can kind of translate. See how you can have the probability being in the money 60 and the delta of 60. So that's why you can use delta as your probability. But also remember, delta tells you how many shares you're trading. So we're also trading about 60 shares of the underlying stock, rather than, and that's how much the option will make or lose in value, 60. And it'll go up and down. That's the convexity that we talked about, right? Convexity is a big term for, well, delta goes up in value or down in value based on whether the market's in the money or out of the money. All right. So the way we trade that, so really all you're really doing, you're going to come in, you're going to do all your mathematical modeling. You're going to say, well, I think the market's going to go up here. This is a good time to buy. I think I'm going to get in. Everything's telling me I should buy right now. So then you're going to come in here. You're going to look at the premium. We generally just want to do at the monies. That's the simplest and easiest. It doesn't mean you can't do out of the money or in the money. You certainly can. Again, it's going to be your delta that you're playing with. Do you want a higher delta or a lower delta? Do you want a higher premium or a lower premium? And then that's the game you're playing. All right. Usually we just do at the money. This is where the market's currently trading. Okay, we'll do at the money. Makes it easy for you. You don't have to make a lot of decisions. The theoretical value, it's close. Well, you're buying it for $1,600. It's worth $1,697. You're getting it for $97 discount. Great, good for you. All right. And then the other thing you really want to look at is volume and open interest. Is the spread going to kill me? Because sometimes that volume and open interest, the spread will be $250, and you're sitting here looking at it, doing all your work, and then you come and realize, oh, the spread's $250. I ain't buying that thing. So this is not a bad one right here. The spread is $15. There's 1,200 people bought it. 22. That's not good. This one here, a lot more, but the market's come down since that was at the money earlier this morning, and that's not anymore. Or it might be just a little bit out of the money. Maybe it's just a little bit out of the money, and people are buying that one. There's 163 people buying that one. 2,000 people hung on to it. The spread is $10. So it's a little bit out of the money, $900. That's people like that one because it's under 1,000. And then it's got a delta of 44. So it is what it is. And the probability of being in the money is 43%. The further you go out of the money, the less the probability is that it's going to be in the money. That makes sense, right? If the further in the money you go when you buy the option, well, the higher the opportunity is, or the higher the probability is that it's going to be in the money, because you gave them a whole bunch of money. It's going to probably be in the money, a little bit higher percent. So there you go. So we're just going to say we want that one. The problem is it's only got, we probably should buy that one because that's where everybody else is. There's 163 volume, 10. But if you want to pay an extra $5, who knows? Just go stick one in there and see if you can get it. All right. You're going to bid for it. We're going to come in here. We're going to go buy. And we're going to come in and we're going to try and get it for less than, the spread is only $7. If you could offer it, you could come down here and say, well, I only want to give you $5. See that little calculator over here on the right-hand side? It says you're going to pay $1,605. You got this little thing right here. And then you can see the margin. There's no required margin to buy an option. And tonight in class, we're going to talk about selling options and collecting premium. And you will need a margin account to sell options and collect premium. So tonight's class, for those of you who are in the class, come prepared to learn how to sell options and collect premium. All right. So right now we're just buying options. We're going to learn tonight sell options. And then that means on Monday we'll have another lab and we'll be selling options and collecting premium on Monday. So if you want to come to that lab, come and do that. So your buying power decrease will be basically the same, 1605. All right. So to buy this thing, we're just going to come in here. Now I right clicked on it and hit buy, and that doesn't actually buy it. Let's go delete it out of here just to show you. All right. Delete. So if I want to buy an option, I'm going to just buy it at the money. I just come in here and I right click on it and I hit buy. Now, when I do that, it doesn't actually buy it. It puts it into the ticket. All right. Now the ticket is over here on the right-hand side, and we send the ticket to the exchange. They fill the order and send it back and tell us whether we got our order or not. So when we hit buy down here, I told the programmers, get rid of that word that says buy. That's confusing to people. They think they're going to actually buy it when they hit that. We should say add to ticket. All right. Add to ticket. Sell order, buy orders, add to ticket or something, because it's confusing to people. You're not going to buy it. It's just going to put it on the ticket. Okay. But the reason you have to have buy or sell is because whether you're going to buy or sell the option. All right. And I oftentimes like to say liquidate. I don't like to say sell unless you're going to actually sell it. So that's a true sell. It's going to actually sell the option. You're going to collect the premium. So we do use buy and sell here. And then to get rid of it, we use liquidate. All right. If we're going to get rid of it, not sell it, because you can sell into a market. If you sell one, then you have a position. You have a short position. All right. So that's the name of the game. All right. So here we go. When you do that, you hit buy in Track and Trade. It's going to not buy it. It's going to put it into the ticket to be bought. And then that draws you a little line on the screen and shows you where your entry point is. All right. Now you can drag that little entry point and you say, well, I decided I wanted to go out of the money. So you bring it up here. Oh, I decided I want to go in the money. You can bring it down here. And notice that it drags down here in the window too. And you can drag it around down here too. You can move it up and down here. That's really cool. It makes it easy to move it to wherever you want it. If it moved or you decide you want it somewhere else, and you can see all the different prices. And so this is really handy when you're building yourself a more complex system. So you have an iron condor on here or something that's got 4 orders. You can sit there and drag them into different locations and look at your mathematical modeling, and you can see where the profits are and the zones are, and you can see how it's relating to the mathematical calculations, and you can see how much money you'll make if it moves here and how much it makes if it goes there, and you can move those all around, and it's really a cool system. All right, so that's why this is so hot, baby, hot. But we're just going to do one. All right, very simple, easy. We're just going to drag it right to the at the money, and we're going to put it right there. That's at the money. And we're going to come over here to our ticket. Now let's just read down through our ticket. And our ticket is telling us that we're going to buy a 147-day option. It's going to expire. This is your expiration 147 right here. You can change it if you want to right here in the ticket. And then let's make the ticket bigger. Yeah, we can see the ticket a little better. It's a 165 call. All right. It's a call option. It's a buy it to be open. You could change that, buy it to close, sell it to open, or sell to close. All right. Those are the 4 choices you have. Buy to open, buy to close, sell to open, sell to close. Pretty easy, right? Simple stuff. And then this is our quantity. And if you want to clear it, you just hit clear. It's gone. Just like that. Now what we're going to do is we're going to come down. Remember, every time we go into and buy an option, we're going into an auction, like a pig auction. You got the pig auction guy up there. We're going to buy that. We're going to sell. Who's going to buy? Who's going to buy 10, buy 10, buy 11, buy 11, buy 12, buy 12. That's an auction. So you have a bid and you have an ask. How much they're asking to sell it to you and how much you're bidding to give it to them. All right. So they're asking $13.60. You're offering the offers are right now at $13.45. They're offering $13.45. The guys who want to have it for $13.60. The difference is the difference between the bid and the ask. That's your spread, which is down here, $15. So the spread is $15 wide. And the midpoint is at $13.52. Now, oftentimes, if you put it in at the midpoint, $13.52, they'll give it to you. And you'll get a little bit of a discount. Instead of paying $15, like it shows down here, you'll get it for $7, which is very cool, right? So I would recommend you always bid for it. It saves you $7. It's enough to go to McDonald's, right, and buy you a burger. So maybe no fries, no drink, just the burger. So saves you $7. So speaking of food, I went to a place last night. I got some chicken wings. Oh my gosh, they were the best chicken wings in the world. We took them down to the park. They were so good. Chicken wings at the park. That was a good deal last night. It was warm enough to go to the park and have chicken wings. So that was nice. Anyway, back to our business at hand. This is the bid and the ask. They're asking $13.60. The offers right now are going in at $13.45. That's the bid ask spread. You want to get in. We're going to go in at the midpoint. We're in the demo account. We can try and see if they'll do it. Usually they just make you go all the way to the bid on the demo account, but we'll try it. We'll place our order. All right. And we put it in there, see if they'll give it to us for a discount. And they're not filling our order. All right. You can tell it's not filled because, first of all, this little triangle in Track and Trade is black. It's a little not filled order. All right. It's black circle. But you can come down here to your positions and you can see, oh, they haven't filled it. You come over here to your orders. Oh, there it is. It's pending. All right. So that's sitting in there waiting for someone to decide they want to give us that order. Okay. The market would have to move in our favor, or actually against us, by $7 for him to give us that position so that somebody could make $7 on us, the guy who wants to sell it to us. We're in a demo account. If we were in the real money account, they would probably take that. But we're in the demo account. So we're going to come over here, back over to our options table. And what we're going to do is we're going to change our bid, all right? Or change our offer. So we're going to come in here, we're going to right click on it, and we're going to say edit. We're going to edit that order. Now you can do it down here too. You can come down here and say edit. It's going to take that order that's sitting down there with the exchange. Now I've done this before where I've gone in and hit edit, and I'm over here saying, okay, I'll pay you guys more money, and boom, they take it. They take it while I'm editing it. That's okay. But what we're going to do is we're going to say, well, let's give them some more money. They want $13.95. I offered them $13.52. The bids out there are $13.80. So they moved. So the spread is 28 now. So I got to move this up, give them more money. So I'm going to bring it up to $13.95 is what they're asking right now. So I got to go all the way up to $13.95. Now I sit here and play this game once in a while. And as you can see, because I sat here and played the game, I'm actually losing more money. So $13.95 now. So now it's going to cost me $15 to get into this thing. Doc Brown, he doesn't like that. He's like, Lance, stop it. Just give them what they're asking and get in. Because by the time the market moves and you sit here and play this game to try to save $7, you've lost $7 in the movement of the market. Just get in. It frustrates him when I play this game, but it's fun. I like to do it. Sometimes it saves me money. Sometimes I get caught and end up paying a little bit more because I waited too long. But it's up to you. It's a game you're playing, and you can play it however you want. All right. So we're going to come in here and we're going to hit modify. And now they gave it to us because we offered them what they asked. Right? They were asking what we offered, and they took the order. Now you can see it's blue. And it's blue because it's a call option. If it was pink, then it would be a put option in track and trade. All right. So that corresponds with this. This is blue down here. If you go to the put options, they're pink. And so the little fill-in thing here is pink and blue. Color coordinated. How about that? Very cool. Probably had some girl tell us to do that, right? Now, keep your software color coordinated. Now, don't all you girls get mad that I said that. Us guys, we're not very good at color coordinating. Okay, so here we go. And that's our call option. And now we're long the market. If the market goes up, we make money. If the market goes down, we lose money. And the max amount of money we can lose is $1,390. And we have unlimited profit potential, right? We can make as much money as the market wants to give us in the amount of time that we've got the option. Now, the thing is we have to also play against the premium per day loss. Now, it's going to lose roughly $10 a day. So the market's going to have to move in our favor $10 every day just to break even. And if it keeps moving against us, we'll lose money on the premium, the $13.90, plus that's the $10 that we're losing. And we'll also lose $10. That's how we'll lose our money. All right. So if the market goes down, we lose about $10 a day in premium decay. And if the market goes down, we can lose a lot more than the $10. That's just premium decay. We can also lose on the options value itself. All right. So the premium will go away as well as being decayed. They'll add the decay to the premium loss. So we need the market to move up. So when you buy a call option, it really kind of needs to move up because you'll immediately start to lose. It can actually move up in your direction and still lose money. And it can do that because the premium decay can be larger than the amount of money that the market made or the option made, because it's making 56 cents for every underlying dollar that the market moves. So it's got to move at least, in this case, 50 cents, got to move at least $1 to make 50 cents. And if it doesn't move $1 to make 50 cents, well, you're going to lose it in the premium decay. All right. So it's got to move in your favor. So that's how it works. That's how options work. There's good and bad to options. All right, let's go do another one. Let's go on Meta. Okay, how are we going to put an order on Meta? Same way. We're just going to come in here. We're going to come in. We're going to go to 147 days. We're going to say, I want this one at $6,000. We hit buy. Brings up our options tab. We just review it. 147, 590, call, buy to open. We're going to just hit market order, hit place, just like Doc Brown. There it is. We got our money. That's all there is to it. It's just an order saying I want to go long. That's all you're doing. Now we're going to come in here, go into the next one, Microsoft. Microsoft, we want to buy one. Okay, we think it's going to go up. So we come in here, we go to options, come down here. We're going to go 147 days, just the same as before. Right click, hit buy. We've already done all the work. All right, we just know we want it. We're just going to hit market and hit buy, and away we go. Now we got one for there too. Now let's go over to the next one. We go down to NVIDIA. Do we want one here? Oh, NVIDIA. Does that look like it's going to go up or down? We don't know. We're just going to come in here and we're going to buy a call option. Okay, we're going to come in here. Let's say we think NVIDIA is going to go down. Again, this is not a trade recommendation. I'm just teaching you. Well, let's say we think the market's going to go down right here. Well, we'd buy a put option. All right. So we're going to do the same thing. We're just going to come over here to the puts. We're going to do this exact same thing. Puts are costing $1,095. The theoretical value is $1,500. So you're getting a bargain on it, which means what they think the market's going up, right? They don't give you something for less money than what it's worth if they don't think it's going in the opposite direction. So they think the market's going up in here, which is why the downside is less expensive than what they're worth. So you got your premium decay, you got your theta, you got your volume 261, 17,000. Lots of people at this level, lots of people buying these things. Look, 21,000 of them have them short here, 261 shorts today. So there's buyers in here, buyers of the put options thinking this market's going down, but the theoretical value is saying it's going up. So we got delta of 0.40 at the money. That's all you're going to get, 40 cents on the dollar. So we're going to come in here and we're going to right click. We're going to say buy. And we're going to come in, just review the same thing, same dates, time, put, open to buy, one. And we can come in here and we can bid for it. They're asking $12 for it. We're offering $11.93. We don't care. We're going to be a Doc Brown. We're just going to say mark it in, hit order, and we're in, filled. All right. So now we have a put option on NVIDIA. And if NVIDIA goes down, we'll make money. All right. So if you think the market's going to go down, you buy a put option. If you think the market's going to go up, you buy a call option. That's all there is to it. Now let's come in here and we're going to go to Palantir. And Palantir, we're going to delete off all our drawings. And we're going to say, well, look at this. This is an X1SA1. Now, Land said the X1SA1 has a 25% chance of going up. That means it could go up a little bit and then flush one more time. Come down here and test this green line, which is a 200-period moving average. So let's say it does that. Well, we don't know which direction it's going to go. I think it's going to go both directions. It could go up. It could go down. So what's really cool about options is you can come in here and you can say, well, I want to buy. Let's go to the traditional view. And now we have calls on the left-hand side. We have puts on the right-hand side. I'm going to buy a call. Watch this. I can come in here and I can go buy. And I buy a call. And I'll make money if the market goes up. And I'm going to buy a put. Buy a put. And I'm going to make money if the market goes down. And I'm going to buy one of each. What a neat trick. I don't know which direction it's going to go. I'm just going to make money either way. The problem is I lose money either way as well. But the difference is that I have unlimited profit potential either direction, and I have limited loss potential. I can only lose the premium that I paid for it, $1,500. So that's my break even going both sides. All the market has to do is make $1,500, which is right here, or $1,500 to this side right here. And I'm going to be in the money. So if that market goes 1,500, go all the way up to 1,500. There you go, Lynn. Okay, so that's the break even on this market. So if we come in here and we put those on there, and we're going out 147 days, which is that purple line, the market just has to be outside of that break even point, and I'll make money because I got one going both directions. So I've got till there. So if that market is outside of that little box I just drew, with this strategy, which is called a strangle, all right, this is called actually, take that back. This is called a straddle. I won't get into it. I'm not going down that road with you guys. This is a straddle. All right. Some of you know my pet peeve about these names on some of these things. So this is a straddle. So that means you have a long and a short, and you put them both on at the same time, and you see both of them in there at the same time. You can do that. That's called a call and a put. And it's called a straddle. And we're going to make money both sides as long as it's outside that box. If it stays inside that box, we're going to lose all our money. We're going to lose all the premium. Okay. Might make a little bit on this premium, but we're going to lose it on that one, and it'll be more than what we made on this one. So we'll still lose. If it's in that box, we're going to lose money. We might not lose 100% of everything we made, but we're going to lose money. All right. Probably lose everything. $3,000 is what that risk is, but it's got to be outside that box by that purple line. So we're going to bid for it. They're asking $31.90. We're offering they're bidding $31.60. The mid is $31.75. That's a spread of $15, but they're not going to give us that because we're in the demo. But if we were in the real market and we bid that, they'd probably give it to us. So we go $31.90, and we're just going to go up here, and we're going to go $31.90, just like that. And we're going to hit place order. Now we have both a call and a put. We go into positions, and you can see just for this chart, we have a call and a put. And you can see combined how much money you're making and losing. Now, if the market takes off and runs one direction or the other, this will become profitable, even though you haven't got anywhere close to that line right there. And you can take your profits off at any point and say, oh, I'm happy I made money. So you can come in here and watch this. This is the cool trick. You can come in here and you can go like this, and you can say, I want to liquidate the multi-leg. And you right click on it here in the, or you can do it up here. You can right click on this little icon and say, I want to liquidate the multi-leg. You can do it either here or down here. And you say, I want to liquidate the multi-leg. And then it puts it into the ticket over here. And again, it's not going to liquidate it until you send it into the exchange. So it's got it in the ticket over here. And then you can tell it how much money you want to make. I want to liquidate it when I make it. Right now, it's down 17%. So you can just run this up until you can change your bid and your ask, right? Because bid and ask, they won't take it if it's not somewhere they like it. So you can run it up until you say, I want to make, and you can just keep running that up, and we can make this a little bit faster. We go 35.00. What is that? That's 9%. If it gets to $35, then we would make 9.72% or $300. So you say, well, we'd run that up to 10%. Okay. If I make 10% or $321 on my trade, take it off. Give me my $321. Well, land, that's only 10%. And don't you want more than 10%? You know what? A lot of people will go down to Cash Valley Bank and put their money into a CD and wait an entire year for 4% or 3.5%. This, I'm saying, I want 10%, and I want it as soon as you can give it to me, within the next week or two or the day or two. It might happen tomorrow. Who knows? But you say, well, I want more than 10%. Okay, well, run it up there a little farther. Go up there to 36. Go up to 36. That's 10.28. That's not enough. We got to go up. Let's go up to 40%. That's 12%. Let's go up to 60. Okay, 60. That's 12. Oh, that's 60. That's went way high. I wasn't getting my numbers. Okay, so 40%. That's 25%. Okay, we'll go down to an even 25%. I want 25% return on my money. Okay, we go in at 39.87. You can see the little profit calculator right there says you're going to make $797, which is 25%. Oh, up one more. 25%. Go ahead and place your order. And don't hit market on that one, because that's got to be a limit order. And it'll sit there and it'll wait until you've made 25% on this trade. Boom, it'll take it off and give you your $700. And then you can go spend it. You can buy your wife a nice present. All right. That's how it's done. That's how you make money with options. That's all there is to it. All right. Let's go look at the next chart. Let's go down to the Tesla. Tesla. All right. We're going to come in here. We love Tesla. So 147. We're going to come in here to our options chain. We're just going to go back to calls. And maybe you think Tesla's going to go down again. Who knows? Nobody knows, right? We don't know. So we'll do both. Let's come in here and we'll do traditional again. And we'll buy one here and we'll buy one here. And there we go. We got ourselves a little straddle. A little straddle in there. All right. That's called a straddle. We're buying one and we're selling one. Or we're buying one and we're buying one. We're buying a call and we're buying a put. So we don't care which direction the market goes. We just want it to move. Now, in this case, our premiums are $4,200 and $3,600. All right. So on the put side, we're going to go down $3,600. $3,600 right there. And on the call side, it's $4,200. $4,200 right there. That's as close I'm going to get. And it's close enough for horseshoes. There's our expiration date. So the market's going to have to be outside this channel by the expiration date to make money. All right. Oh, my channel's red on this one. Okay, so there's your break-even channel. All it has to do is be outside that channel by that date, and you'll make money. Or you can say, I just want to take it off in the meantime, anytime in between here, if I make a certain dollar amount. But we got to get it in here first. Let's go ahead and we'll just put this one into the market order. And we got our market order, and we're in. We're into Tesla with a long and a short with a straddle. And now all we have to do is come in here, right-click, say liquidate the multi-leg. Boom, 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 just like that. How much money do you want to make? Oh, I want to make a lot of money this time. It's Tesla, and it's going to move outside that box by a long ways. So it's sitting there at 80. Let's go up to 90 and see where that puts us. And run it like that. That's 13%. That's $1,000. Let's go up to 100 and see what that brings us to. That's 26%. That's good. Let's go up. Let's go That's $2,000 we could make on 26%. That's good. Let's go down to 25%. We're going to bring it down. Let's say even $2,000. How about that? So it might be, well, $2,000 is going to be right around 25%. We just run that down with our little clicker. You can type it in and go a little faster, but this is good too. So there we go. There's an even $2,000. So at $2,000, that's 25.27%. So I want to make $2,000 because I need a house payment. All right. You know, buy my house, $2,000. I need that. So we're going to come in here. We'll mark it in there and we'll just say, when you make $2,000, give it to me. All right. And as long as Tesla moves outside of that box, you'll start making money. And if it makes $2,000 anytime inside that box. Now, remember, it's got to pay for the other side. So this one will lose money as this one makes money if it starts to rally, or this one will make money on the way down. This one will lose money. So it's got to kind of work together, and it'll take a little while. And as markets move through price and time, you know, it'll run, it'll move, maybe, or Tesla could just stay in that box for that whole time. Do you think it's going to do that? If it stays inside that box, you're going to lose your whole amount of money. How much position we got in here? We put in right here. It says right here, our cost basis, $7,915. All right. So let's put me up here. Let's put me up here. How come I can't get up there? There we go. So you can see right here. All right. So one is making $250 and one is losing $50. That's the spread that we had to pay just to get in. So $45 is what it cost us to get into this thing. Now the market just has to move. That's all it's got to do. And then you make your $2,000. You got your order in there. Let's put that order. Oh, we do have the order in there to get liquidate, didn't we? No, we didn't. We just talked about it. Let's do it. Liquidate the multi-leg. That was to get in. Oh, and then we marketed. How did I do that? Oh, ignore what I did. We just marketed in. I don't know what I was thinking. All right, let's go back up to 100. This is to get out, not to get in. 26%, 2,000. We got to bring that back down. Land was drunk. Now we were just getting in. All I needed to do was mark it in. So we got them. Now what we need to do is we need to come in here and set where we're going to get out. So we're going to come down here, 25. Got to run it back down to 2,000 again. Sorry. I wasn't even in the market, and I was talking about getting out. So we're going to bring it down to 2,000. There we go. Okay, now it's got to be a limit order. All right, so now we can go ahead and hit place the order. And that's the credit. And so that will get us out when we make $2,000. Sorry, we had to get in first, and I wasn't even in yet. So I was sitting there dinking around trying to make a bid, and we ended up getting in at the market order. So now we've got an open position. There it is. We got an open position to take us out when that market gives us $1,000. All right, that's the game. And you can reset that at any time. You can come in here and you can delete this at any time. Just come in here and delete it and put it on again and put it at a different price. It doesn't matter. It's just a pending order. So it's pending to take it off when it makes $2,000. If you know, well, it might not make $2,000. I want $1,000. So you can come in here, take it off, and reset it to take it off at $1,000 profit. All right. As soon as it makes $1,000 before that purple line, there you go. Money to be had. I would recommend that you come in and you put about 10 of these on all of these markets, or at least 7 of them. All right. There's the Magnificent 7. Go put one of these orders on 10 of these and watch them. See how they make money. See if they lose money. See, that's the way you learn. Go put 10 of them on. And then you can learn a lot faster. You learn 10 times faster by putting 10 of them on than just going in and putting 1 on. And if you run out of money, it doesn't matter. I mean, you're in a demo account. You just got to learn. So go put 10 of them on. Go put 20 of them on. It doesn't matter. And then you're going to learn 20 times as fast what the market does and how it works and how those options make money. All right, guys, that's about all I got for you today. If you want to know the software I'm using, it is Track and Trade. All right, you can go get a copy of this software here, Track and Trade. It's that little blue one. It's the one we're using. 7 times Stocks and Commodities Annual Reader's Choice Award. Since this graphic was made, it's won it again. And then that's trackandtrade.com. Just go over there, download that stocks version. That's the version we're using here. And then you can trade options like this. Very simple, very easy, drag and drop options. Makes it easy, makes it fun. And you can do it too. All right. I don't get it. How come I can't make this thing work the way I want it to? It used to work. They changed it. They updated this software. Now it doesn't work the same. Okay, there we go. Any questions? Any comments? Let's see. Randy says, I have a share. March Pit News article by Jordan Black inspired me to purchase NVIDIA Tesla Coney 2 days ago. I got paid today. My Tesla made 120 on 261 shares. Thanks, Pit News. There you go. Making money. Hand over fist, man. That's right. Today was dividend day on Tesla. I got my dividends too. So nicely done, man. Way to go, Randy. It's good to see. Everybody wants Pit News Magazine. If you don't have Pit News Magazine, what are you doing? What are you doing, guys? You got to have Pit News Magazine. There's Pit News Magazine. You can get it for 50% off right now. Get it for 50% off. Only $19.97 for an entire year. And look at that. Randy paid for itself in one fell swoop, one trade recommendation. And Randy already paid for his Pit News Magazine subscription of $19.97 for an entire year. It's regularly $39.95. Why wouldn't anybody want to pay $19.97 to get this? You get a 50% off. Just put in 50% OFF. There will be a little blue line pointing at it when you're there to check out. Go over to pitnews.com. Get this magazine, and you can have the tips and tricks that Randy just took advantage of right here, right now. Go get it. All right. How come I have to remove before I can add? I didn't used to have to do that. All right, guys, that's all I got for you. We're going to let you go, and we'll see you tonight in class. And we're going to learn about selling options and collecting premium. And then on Monday, we'll go through and we'll sell options and collect a bunch of premium. Okay? That's how it's going to work. See you then.